Hey, good afternoon, everyone, and thank you for joining us once again for the webinars that we hold for the SBDC. We always try to bring you resources, information, and training that is going to help build your business scale or help your business grow wherever you're at. And I know that one of the most important resources in order to be able to grow is funding. We had Buva a few weeks ago teaching on alternative funding. And at that point, she did a little bit more high level, and she was also talking about venture capitalism and different types of investments. But overwhelmingly, a lot of you had questions about angel investment because that's the lowest level to start out when it comes to the type of capital lending that she discusses. And so we decided that it would be good to have her back so that she can dive down a little bit deeper into that. If you've never worked with the SBDC and this is your first time, we not only offer training like we're doing today, we also offer in-person training from time to time, and we also offer free consultations. So if you're interested in working with one of our consultants, we're going to drop the link in the chat. If you are not already an SBDC client and you don't already have a consultant. This webinar is going to be recorded. Tomorrow you will get a copy of the recording and you're going to get a copy of the PowerPoint slide as well. Also, as you're listening to Buva speak, if you have more questions or you want to speak to her directly, I just ask you that you send me an email. Request counseling first if you're not you're not a client with the SBDC. Send me an email, and then that way I can connect you with Buva so that you can work with her to get some of those initial questions that you have. You are going to be able to work with her a few sessions without any charge to you. So please take advantage of that. So without any further ado, I'm going to pass it on to Buva so she can get started and I'm not taking up any more of her time. So thank you very much.
Thanks, Anna. Thanks everyone for joining today. Hopefully I'm seeing some of you from last time as well. So like Anna mentioned, last time we spoke a little bit about all types of alternate fund options that included angel investing, venture capital, and many others. These are alternate sources other than your typical loans and grants. Today we want to deep dive into angel investing more so for the only reason that's a very traditional pathway into next levels of alternate funding beyond loans and grants. That's the lowest level of funding option that you can start with, and then you can keep building up the capital ladder. By way of introduction, I'm Bhuva Shakti, a product operations and fundraising advisor. I help businesses build systems for growth. I've worked for more than 25 years at the intersection of technology, finance, operations. Originally started on Wall Street, led digital and AI transformations, recently more in the angel and venture capital ecosystem. But in both spaces, I've mostly worked on fundraising or capital raising for small businesses, medium and large corporations, investment banks, and so on and so forth. So sometimes you may need funding, not just to establish your business, but when you want to launch a new product or expand into new markets, or even you know that you need funding, but how do you attract investors and shape your business in the right way? So those are a few things I can help with to build not only just the fundraising aspect of it, but what are required in your business to be attractive for investors. Because fundraising is not about creating the best fundraising plan, but your business, your product, your service, your operations, everything should be also attractive that you're able to present to the investors. So along those lines, I also offer, like Anna mentioned, counseling sessions. So feel free to email Anna and reach out to us, and we can provide resources and other areas that we can support with so we can position you for fundraising. I think links are also in the chat. Take advantage of that. So I'll quickly go into today's agenda. So today we'll focus only on the angel investing side of things, even though there are a lot of alternate private investments. So we'll talk about the life cycle, right from outreach to funding and what happens in the follow-ups, during and after fundraising. Also, where can you find these investors, right? So that's the big question. You have a solid business, you know you need to fundraise, you've created a fundraising plan and all the materials required. Now you need to find the right investors that match your business type, your stage, and things of that sort. I will talk about that a little bit today. And then we need to review all the core materials needed for fundraising. One of the common things everyone thinks about is just a pitch deck is sufficient, but that's not all the case, right? So we spoke about it last time also. Think about pitch deck as a resume. When you're trying to apply for jobs, you send out your resume, then the employer is interested to talk to you. Then you take other materials and then you have an interview and maybe one or two more rounds of interviews. So we'll review all the core materials needed for fundraising beyond just pitch deck. You may need some metrics, one pages, and so on and so forth. And then we'll talk about some tips and tricks to handle investor meetings. And lastly, today we are going to leave with a 30-day action plan, approximately 4 weeks. So what can you do starting today over the next 4 weeks on a week by week basis so you can progress on your fundraising journey, right? Now, before we go into how to fundraise, what do we need, our 30-day action plan, let's take a look at what is private investment and who these angel investors are that we hear about quite a lot. Angel investing exists because, as I mentioned earlier, traditional capital may not always fit early stage businesses. Sometimes banks want collateral, grants take long time. There's a lot of competition and wait list. Venture capital investors, private equity, and so on are a little bit more at the later stage when you are really scaling and expanding. But there is this in-between gap where you need funding to grow a little bit before you can raise more funding while you are waiting to get a loan and a grant. This is where angel investors step in. They bring expertise, money, and relationships. Angels are slightly different from any other type of private investors for the reason many of them are former business owners themselves. They typically invest locally, which means if you are in New Jersey, New York, or in the tri-state area, you will very well find an angel investor locally right next door to your place because they invest in a known industry and a known location, first and foremost. Secondly, also, they like to mentor the founders, which means they are always looking to introduce partners, suppliers, or other connections beyond the check they give you so that you can expand your business. And angel investors, they are typically investing their own personal funds. They can invest anywhere between 10K to 250K per deal. Sometimes what happens is if you need, let's say, 50K, you may have five angel investors investing 10K, or even sometimes I've seen 20 angel investors investing 5K each independently in your business. So the options are unlimited and they don't fall under a partnership hierarchy or anything like that, which means personally, if they decide they want to invest in you, they can invest in you right away. There are no additional things that they need to get checked off before they can invest in you. Now, angels expect returns in 3 to 7 years. So they look for promising founders who are coachable and have a clear growth plan. Since they know that they are investing in early stage businesses, they are not going to expect a lot of customer and revenue traction, but they need to see that your business is viable. You are able to get at least few customers or able to generate some revenue, one or the other, or sometimes both. That's why it's really important to have alignment with the angel investor. And also, like I earlier mentioned, since they don't have external committees and things like that, if they think you are the right founder, your business is the right business, they can invest right away. And more importantly, they also invest in the founder. It's really important to invest in the founder and the founding team, not necessarily the business for the reason because it's still early stage. They need to be able to trust the founder to execute as per the business plan and the roadmap. They also try to invest even if there is some risk perceived. So someone else may think that your business has not generated revenue. You have some customers, but if angels see a potential, they are willing to invest because that's the risk calculation that they take upon themselves because they want to invest in a local business or a local community or industry that they want to be involved in. One other thing is also, I think we spoke about it last time as well. They will need equity because when you take a loan from a bank, they're going to expect you to pay back the principal and the interest immediately. When you get a grant, like I said, there's a lot of competition and it may take a little bit time. So angels are able to invest money in your business without asking for any payments on day one. They're able to invest as quickly as possible. If they like you, they're not going to take a long time before they make the investment. So what do they get in return? They're going to get a minor portion of your equity, also known as ownership in your business today, instead of asking you to make payments today. But then this is equity that you can always purchase back at any point in time in future when you think you are able to generate profit. So um, always talk to a lawyer in terms of what and how you need to package this equity if you're not aware, but definitely also talk to us. We can brainstorm some ideas as to how to position this. Now, let's look at the fundraising journey. I'll more focus on an angel investing fundraising journey. In a typical fundraising journey, there are 5 stages, but sometimes some of the stages may repeat themselves. In the sense, consider it like a job interview. You may do 2, 3 meetings before you may get to the next step, right? So, similar to that, you may have more than one meeting to keep progressing on your funding journey. Now, this is a 5-step angel funding cycle. This is the end-to-end roadmap. Like I mentioned, the process is typically not linear. It loops back as you refine your pitch or meet more investors. But think of these 5 steps as checkpoints. Number one, you're going to research because, like I mentioned earlier, finding the right investor is more important than finding many investors because when it comes to angel investing, the industry, the business type, the founder, and the geography, the local community matters quite a lot. So, finding the right investor is critical in step one. Research, do your homework. So, outreach feels intentional. Uh, don't try to send cold emails. Do some research and try to send some personalized emails, even if you don't know the investor. That's really important. And step two is related to outreach, right? Um, the first email that you send to an investor, be it a warm outreach or a cold outreach, should not have a pitch deck because it is just an invitation asking the investor to have a meeting with you. So it's really important to outreach and ask for a meeting before you send lot of documents to the investor. And also, it's really important for your own confidentiality. You don't want to be sending your business documents to anyone and everyone just over email, right? So you don't know what's happening on the other side. So it's really important to outreach, schedule a meeting, and then send a pitch deck, and then go from there. Like I mentioned, step three is the pitch deck. Typically, 10 slides are recommended because that's all the information you need. You need to be able to practice to tell your story in 5 minutes. Uh, Investors get a lot of pictures and decks every day. So if you're not able to get the key points of your 10 slides in the first 5 minutes, then it might be slightly difficult to keep the investor interested. Don't try to give all the information right away. Give what's necessary for the first 5 minutes, and if they are intrigued, they'll ask for more. And then step four is due diligence. So don't consider due diligence as a test, but it's verification. Same as how you go for a job interview. You're doing multiple interviews with an angel investor. They're verifying your problem solution, your unique business plan, and things of that sort. So try to organize all your data early. It's really important to have a clean data room folder. Pitch deck is one document there, but there are many other documents. If you want more information, we can always talk about that and see what you have and how we can repurpose some of what you already have instead of creating anything new. And the last step is legal and closing the terms, right? Negotiation, always have an attorney with you. It's really important. Though you need to know some basics, but leave the legal matters to an attorney. Ensure that you're very clear about what your rights are during and after funding comes in, what are the investors' rights, how much equity both of you are signing up, and so on and so forth. Uh, when you get this funding or the check from the investor, think that your relationship with the investor is just starting, because that's the first day your investor is going to be actively involved in your business as well. So post-investment communication is also really important to keeping them engaged with quarterly updates and milestones and so on and so forth. So right after fundraising, don't leave it hanging, because if you want to fundraise a second time or a third time, existing investors, if you are able to keep them engaged and informed, are more than willing to invest second time or third time with you. So try to maintain that relationship. Now, as I discussed, the 10 slides, the 5 steps are basically the typical funding journey. Any fundraising story typically follows the same model, where you identify potential investors, make contact, you pitch your business, you go through due diligence, you close the deal, and then manage the relationship after fundraising is complete. What happens when I say you're going to loop back is when you present a pitch deck, if the investor has more questions, they always allow you to go make revisions to your pitch or other materials, financial statements, or anything else that you think that they need more clarity. So don't think it's one meeting. If you don't make it a successful meeting, you will never get a second opportunity. So that's why it's more a feedback loop where they will give feedback, ask more information. You always have room to go and update, fix, or add more and come back for a second meeting. So there'll be multiple touches. It could be meetings with the same investor before you get the first yes, right? So with our discussions, what we can do is short circuit that time, right? Instead of going to an investor unprepared, we can prepare as much so we can shorten the cycle or the time it takes for you to get that yes. And the goal is also not to really rush through the steps, because early research and outreach is really critical to follow the next step. So it's really important that you're able to spend some time, find the right investors, write those personalized emails, get few meetings instead of trying to reach 100 investors in one shot and not able to get a reply from many of them, because if they don't think there is fitment, they may not come back to you, tell you that they will have a meeting or not a meeting. So angels typically look for a strong founder and a team. Clear market opportunity. Is there a market need or industry trend for what you're offering? Do you have early traction? So like I mentioned earlier, it need not be revenue traction. It can be customer traction also. So customer traction is equally good because customers are looking for your product. If you have revenue traction, that's a plus. But even when you don't have revenue traction, you can always talk to angel investors. So that's why they are kind of the starting step of alternate funding investments. Then scalable business model and exit potential. So what is your business model? How are you going to generate revenue? How are you going to find customers? How are you going to grow? So those are details that are more important for the angel investor to know than are you generating revenue today. So if you pause and look from an investor lens, an angel is going to primarily ask for will this founder use their money wisely and then try to make a return? So that means they pay close attention to your judgment. Are you disciplined about numbers? Do you know your financial projections? Do you take feedback well? Because, like I mentioned earlier, They would like to mentor the founders that they are investing in. So are you able to take feedback and address it and then come back to them? It's also important that you should know where the money will go after you receive the funds, and you should be able to communicate that transparently to the angel investor. Half the battle is trying to raise the funds, but they also want to know, once the funds come in, how are you going to use it towards the growth of your business, right? So as long as you are able to clarify some of this ROE and ROI framing, then it's really important to get the check and the meetings with the investors. Now, if we deep dive into finding the right investors, each business stage and founder mission is different. So not all investors fit all types of fundraising. The goal is to find your right fit. So in terms of outreach and introduction, you can see that, like I mentioned, angels prefer proximity. So try to reach out to local angel networks. I can share some resources as well after the call. But there are investors in every state and almost every city in the US. So look for community-based groups. Look for specific investors in your city, town, state, or even like for us in New Jersey, the New York metro area is a good resource. Many of them also host open pitch nights, meaning if you're not able to secure a meeting, if they are hosting a pitch night or a event where they invite any startup or small business to come and talk about their business, take advantage of that, because that way you're on a stage presenting your business to a room full of angel investors. So you don't have to wait for that meeting to happen, waiting for them to reply your email. So look for those opportunities in your local network. Many of them happen online also. So you don't have to be in person. You can also go present your business in virtual pitch events. You can also meet angels through NJS BDC, accelerators, local chambers of commerce. And if you are using LinkedIn or any other social media, you can also search based on your industry. So there are a variety of ways where you can look for investors outreach, but also don't discount options where there are open pitch nights where you can go and present virtually or in person to a room full of investors, kind of really shortening the time that it takes to reach them, right? So more importantly, your outreach should be personalized. Just because you have to talk to 10 investors, don't try to send a generic email, put all of them in BCC and send out information, because each angel investor wants to know personally why you want them to invest in you. So personalizing emails gets you a faster response. But in some scenarios, if you don't get a response, if there is a no response, it is always helpful to keep the introduction warm with the investor, because they may not be investing today, but they may invest in 1 or 2 months, or they are waiting on something, or they may introduce you to some other angel investor friend that they have who is investing currently. So it's really important to personalize the emails to get faster replies. And even if there is a no, try to keep the connection so they may be able to introduce you to someone else who can invest in you. Now, here I also wanted to talk about warm introductions and cold introduction. I think all of us may know what's the difference. A warm introduction is you know someone who knows someone who is an angel investor. If that person who is a common connection between the two of you is able to make an introduction, that gets you a meeting directly, because a trusted referral signals credibility. And it also saves investors time trying to vet you, right? So not only you are trying to reach them, they also want to vet you. And if a common connection is able to make the warm intro, much faster, much better. To find common connections and get warm introduction, start with your immediate network. Don't discount anyone. You may talk to your customers, your professors, your service providers, fellow entrepreneurs. mentors, ask them, do they know any angel investor who can make an introduction? And when you ask for a warm introduction from someone else, don't wait for them to to write about you. Give them a short paragraph or something like that that they can immediately copy paste in an email and send it to a potential investor. That way it saves time. You just tell them, hey, introduce me to this angel investor. Here is a short paragraph about me. Don't send pitch decks or anything like I mentioned earlier. And once they make the introduction, then ask them if they are willing to hear your pitch. The second option is, even if you don't have connections who can make warm introduction, don't rule out cold outreach entirely. Like I said, if you think there is someone who is a good angel investor fitting for you in your local community, you can always send a personalized email, but do your homework, mention what is your business unique proposition and why they should invest in you, and then ask for a meeting. Don't send big pitch decks at the start because they may not read it. But just because they don't read it at the start doesn't mean you should not have it ready. Because as soon as you send an email, if the investor says, hey, I'm available in the next couple of days or next couple of weeks, let's get a meeting on calendar. At that time, you don't want to be struggling to create a pitch deck. So have your materials ready while you're trying to outreach and schedule the meeting. So you definitely need a one pager, which is a short summary of what your business is about, what is the funding ask. You definitely need one pitch deck, which has 10 slides, which we'll talk about a little bit. And then you need a data room. A data room is nothing but a place where you keep all your financial statements, legal documents, and anything else that the investor can look at for review when your meeting is scheduled. So don't try to create these materials after the meeting is going to be on your calendar. Try to prepare them as you're trying to outreach. So your one pager typically summarizes your business model, traction, funding goal. It doesn't have a lot of information, but in one page gives you a high level summary. But your pitch deck expands on that story visually, where it's going to give a lot of additional information on what each of the components are about your business. A data room, like I mentioned, is a place. Sometimes it could be a Google Drive also, where you can keep your financials and legal documents for investors to look at after you have scheduled a meeting. So that's really important. Don't send these in details to anyone while you're trying to outreach. Don't share them in public without knowing who you are sharing it with. So we spoke a little bit about equity at the start. Uh, Equity is nothing but minor ownership for investors in your business in return for giving you money while not expecting any payments from you for few years. You don't have to make payments for few years, which means they need guarantee that you will be able to generate a return and profit. And that's the reason they would like a minor equity ownership in your company. Sometimes they will just look at other competitors in your space and come up with a number. You also don't try to create the perfect number because it may change as per the market needs and the negotiation you have with your investor. So it's really important to see what the market trends are and what your angel investor fitment is. Sometimes if you're unsure, use online startup valuation calculators. Some of these are available, but again, we don't know the credibility of them. So it's also better to talk to mentors who have seen similar deals, someone who can guide you through this journey based on your specific industry, economic trends, customer and market demand for your product or service. So feel free to talk to us also to guide you through this process. Now, let's look at the pitch preparation materials. Like I mentioned earlier, pitch deck is just one part of it. There are other documents you'll need, but today we'll go into a little bit detail as to how to create this pitch deck, which is ideally 10 slides of content, right? You can always have any number of extra slides in the appendix, but the universal format that most investors expect is as follows and in this order, because one slide builds on top of each other. So the first is a problem slide. What problem are you solving? The second is a solution slide. Third is a market slide. Fourth, traction. Fifth, product or service, whatever you offer for which you are fundraising. Sixth is the team composition, why you're uniquely positioned. The seventh slide is competition. Who is your competition? It's really important to understand that as well. So you can be uniquely positioned. And the eighth slide is typically the business model. What is your business model? How are you going to acquire customers? How are you going to generate revenue? The ninth slide is financials. So financials is about what is your cash flow, profit and loss, balance sheet, and what are your projections for the next 1 year, 2 year, whatever the timeline you want to talk about, and what is your ask. What kind of funding are you asking? Are you asking for 50K, 100K? What are you going to do with that money once the funding comes to you? So the 10th slide is the ask. So when it comes to your deck, really ensure that the angels are able to understand it in under 5 minutes. If you try to add more information, you may not catch their attention. So ensure that each slide talks about only one point and it must communicate a key component of that one point. For example, your problem slide should make someone say, oh yeah, that's a real problem. I can understand it. People should be able to relate with it. On your traction slide, you should be able to showcase customer, partner, revenue traction so that it gives proof to investors that your business is working. That is demand. So it's also important to use simple language without advanced industry jargons because the investors should be able to visualize the problem from the end customer perspective, how your solution is solving a customer pain point today, and what is the after story. So after the customer uses your product or service, does it save them money, save them time, make their lives better? So those are the things they are interested in understanding. So don't try to use a lot of industry advanced jargons that may confuse the investor also. And more importantly, do you have test customers? If you have test customers, always get written testimonials from them. It goes a long way when you're having an investor conversation. If you're trying to enter into one pilot market and then planning to expand, what is your initial pilot market? Why did you choose that? How do you plan to work in that initial market? How do you plan to expand? Where do you plan to expand? These are questions that you should have handy. And also, that's the founding team, not just only the founder, an entire team. Whoever is with the founding team, when you're fundraising, are they committing to the vision of your business? Do you have realistic financials? It may not be generating 80% profit or 90% profit, but is it realistic? And it should not be way off from your competition because they're going to also compare you with your competition. Even though you're comparable with your competition, it should state how unique you are, right? So that's the unique value proposition that your business can lean on. And then in terms of readiness, even if you are pre-revenue, like I mentioned earlier, customer traction, partner traction, market traction are all good enough to start reaching out to angel investors. Always make sure your financials are current, your legal structure is clean. Even if you don't plan to fundraise, these are things you should have in place even today, even without fundraising today. So your metrics, they should be tracked monthly. Also know your fundraising goal down to the dollar amount and what it funds. If you are trying to raise, let's say $75,000, you can potentially say something like, I'm raising 75K for inventory and marketing so that I can acquire 500 clients. So the fund is used for something that will translate into something, right? So you need to have that story ready. In this example, uh, you are raising 75K for inventory and marketing so that you can acquire 500 more clients, right? So it shows a clear transfer of funds into customer and revenue traction. And also being ready is not about being big. You don't have to be generating multi-million dollars to reach angel investors, but you need to have a solid business model. Don't try to have multiple business models, have one or two. And this is where unit economics comes in. I'm thinking that some of you are aware of unit economics. It's as simple as what does one unit of your product or service cost, and how much is your customer willing to pay for that one unit of product or service you offer? And then how many customers will you acquire for generating revenue within a certain duration? It could be something like the cost of uh, creating one unit of your product is $1 as an example. The customer is willing to pay $3, which means the profit margin is $2 minus any expenses and taxes. If you have to generate $3,000, you will have to acquire as many number of customers who are willing to pay the $3 within 6 months, 1 year, 3 years, whatever is your time duration. So business model is important, but unit economics is also really important because that is what will drive your break even, your return on investment, and future profit and expansion. To state all this, it's a lot of numbers, but even though numbers are there, you need to tell a real customer story to the investor. So storytelling is really important. Basically, how will one customer use your product or service, pay, and transform their life in terms of cost, money, or time, or anything else that makes their life better? So, like I mentioned earlier, investors see hundreds of such decks every day, every month. So it's important to stand out by clearly talking about four things. I'm detailing it here as the four steps of your story, right? So always start with the hook, then describe the journey. All of this is from a customer point of view. Your customer, what is their journey in using your product and your service? Provide evidence, and finally, talk about your big vision. Typically, your pitch will start with why this problem matters. Why are you even solving this problem, right? So from a customer point of view, then you walk through your customer journey as to how you solve that problem for that customer. The third step is evidence. You will have to show some evidence that it's working. Customers want it. You have more test customers. Some of them are paying today. You're trying to get more customers and expand your revenue. And that's why you're fundraising, right? So having those details handy in a story format is really helpful instead of just showing numbers, because investors don't know your business and you have to explain your business to them. And of course, share your vision as to how you will scale. If you have some customer testimonials that are written testimonials, that is more powerful than creating 20 slides. So it's really important that every investor meeting, you answer 5 questions, right? Number one, what problem are you solving? Why now? Why now your product or service is relevant? How big is the opportunity? Is it going to be all over the East Coast, all over the state of New Jersey, New York, or is it going to be something that everyone in US may need it, right? So you need to quantify that. Who is your team? Because if you're talking about growing your business, taking alternate funding from an angel investor, who's the team? How will you use the money? And how are you going to get the returns that you're talking about? So that's really important to articulate, and that can be done along with numbers in a storytelling format on the slide that I've shown the steps. And then we are coming towards the close of the presentation today, but a couple more things before we sign off. Once you have gotten the meeting, you've reviewed everything, you've completed all the questions that the investor asked, you're now ready to sign the agreement and close the deal. Definitely ensure that you consult a lawyer. Most startup lawyers offer flat fee packages for one funding round. There are many lawyers who support small businesses who may not ask an hourly fee. Rather, if you're fundraising for a month or two, they may offer a flat fee that is a little bit cost efficient for you as well. And to close the deal, definitely the deal is not closed until the funds hit your bank account. So it's really important to ensure everything is in writing, starting from payment dates, when the funds are transferred, and as soon as funds are transferred, definitely give a thank you note to the investor and start talking about further updates. So the investor relationship starts when the funding hits your bank account. Now, I'll share a quick checklist. We spoke about a 30-day action plan. We'll walk through that quickly. So 30 days, approximately 4 weeks. What are things that you can do or start today for the next 4 weeks, starting today, like I said, that can progress you in a certain journey through your fundraising. Now, week 1, focus on researching local angel groups. Try to shortlist 5 to 10 investors that you think may be a right fit for you. Send an introduction email, or if you know someone, ask them to introduce you to the investor. In either scenario, try to send a short personalized email with what you are looking for. So that's week 1. Then week 2 of your 30-day roadmap, try to refine your pitch deck. Use the 10-slide format that I shared today. And remember, pitch deck is just one document. There are other materials that you need to get through this process. So always keep them ready ahead. Don't try to create them when the investor is waiting for a meeting. Then you may lose the opportunity to even meet the investor. So in week 3, from the shortlist of angels that you've identified in your week 1, try to begin outreach with a more detailed but still a personalized email to the investor asking them for a pitch meeting. Do the same for all the investors you've shortlisted from week 1. The big difference is don't try to email the pitch deck. If at all they ask something, try to send that one pager that has a summary of everything. Because if your pitch deck has confidential information about your proprietary product or service, you want to be really sure that you're not sending it to anyone and everyone and you don't know what happens to it. So that's why it's important to have multiple documents handy so that you can use it for every other meeting, not share all your confidential data on day 1 if you have not met the investor yet. So in week 4, you will typically shortlist and schedule at least 2 meetings from the original list of 10 people. Typically from week 4 and 5 onwards, it's going to be a loop, like I mentioned. So you'll pitch once, they'll give feedback or ask questions. You're going to go gather them and come back and meet the investor. It may happen 2-3 times, same like a job interview, 2-3 times. There are 2-3 rounds. It's not only a place where the investor is asking you questions. Think of it as the time where you are also vetting your investor because they need to be a right fit, right? So you need to know that they meet your needs. You need to get your questions answered. So it's like the two of you trying to vet each other. So it may take more than one meeting, but it's really important to consistently keep the effort and do the follow-up on a week-by-week basis. So um, if possible, today is Monday, try to start with this weekly plan and see how it goes in 4 weeks. If you have any questions, feel free to reach out to us. We can talk about what kind of support you need. Now, lastly, I just want to quickly touch upon things that you should not do when you're trying to talk to an investor. Number one, many people try to overpromise revenue. Don't do that because if market conditions change, if economy is not good, then you would have overpromised something to an investor that may kill your credibility. Second is poor documentation, right? Have your documents ready before you're meeting the investor. And if the investor gives feedback, feel free to go back, update the documents and come back. Investors are always willing to have multiple meetings with you. And the most important thing is don't try to chase investors who aren't a fit. If you are trying to find one type of investor, if you reach out to other types of investors who may not be a fit, they may not respond to you, and you'll be wasting your time and effort trying to reach them. So try to find who your ideal investors are and stick within that lane, even though there are multiple meetings happening. Trying to reach investors who don't fit your lane is not going to be useful there because they may not even respond to you. More importantly, if you get a bad investor who's not the right fit for your business, it may do more harm than good for your own business. So it's really important to ensure that. And like I mentioned earlier, post-investment, keeping detailed reporting, ensuring the investor is up to date, monthly, quarterly metrics, revenue, churn, what are the other things you need from the investor to grow the business. Even after fundraising is complete, investors are constantly willing to make introductions and connections for you to grow. So think of them as an additional team member who doesn't take salary from you and has invested money in you. So that's how angel investors try to help founders. So I'll do a quick final summary of all the checklists we've reviewed so far. Things that we looked at today before you fundraise, during the fundraising conversations, and after you receive funds. So this is where we'll close. Typically, look at your 30-day action plan that I shared now. Take one step today or this week. Maybe you can build your investor list or clean up your financials or schedule your first mock-up pitch session. Whatever that is, try to take one step today or this week. To summarize the checklist we reviewed today, first we reviewed the funding readiness checklist. Things you need to keep ready before you start fundraising. Cover your business basics, legal entity, bank accounts, financial statements, document your traction, customers, partners, return testimonials, prepare your pitch materials, 1 to 2 page summary, data rooms, 10-slide deck, and also your funding plan. How much do you need, what it's for, and the milestone. So this is the first checklist we saw. This is list of things you need before you start fundraising. So these are things you can keep ready in your week 1 of your 30-day action plan. The second checklist we saw today was the pitch deck itself. The pitch deck has only 10 slides. You can put anything additional in the appendix, but in this order, it's important to ensure so that your story builds on top of each other. The first slide is problem, second slide is solution, third is market, fourth traction, fifth is product, sixth is team, seventh is competition, eighth is business model, ninth is financials, and the last slide, 10th slide, is funding ask. How much you need, what are you going to use that for, and by using that for a certain purpose, what will you generate in terms of revenue, customer, market, or partner growth, right? So these 10 slides are important. And the third checklist we saw today was the storytelling format. So you have all your financial statements, legal statements, you have your pitch deck, which has the content, but how are you going to present it to the investor, right? So this is where the third checklist about storytelling comes into play. We saw 4 steps in a storytelling format. Number 1 is the hook, your why or the problem you're solving. Number 2 is the journey or the solution that your customer will take and go through a certain journey to solve their pain point. The third thing in a storytelling format is evidence. It could be customer traction, revenue traction, both, or something else, but there should be some evidence that there is demand for your product or service. Someone is willing to pay so that the angel investor can confidently invest in your business. And lastly, the big vision. You are generating customers, revenue, some traction today, you're raising funds. So what's going to happen once the fundraising finishes? Meaning, how are you going to expand or grow after funding comes in? So that's the 4-step storytelling format. And today we also reviewed your 30-day action plan. We also looked at the entire roadmap for 5 funding stages. And we also looked at the do's and don'ts in your roadmap. Now, if you need any support in applying what we covered or even trying to determine what you need, how you can repurpose what you have, reach out to us like Anna mentioned, send Anna an email, and then we'll be able to talk to you and help you figure out what you can do in the next week, next month, whatever your timeline is, and we can create a personalized funding roadmap. And one thing is really important, always make sure to not overpromise, but also maintain the funding relationship, because angel investors typically invest repeatedly in the same founder. So if you need more future funding, try to maintain the relationship even after the current investment comes through. Thanks everyone for joining in. I'll probably take a pause here and hand it over to Anna to see if there are questions that we can answer for you in the remaining time we have.
All right. If you have any questions, please put them in the chat, or if you want to unmute yourself, you can also do that. I do have a few questions, Buva. So the first question that I have is, how much is typical for an angel investor to give in equity? Let's say you're a brand new business, you've only been in business for less than a year, you've made a few $1,000s in revenue. What would be like, is there a typical amount that an angel investor will give if you're in that type of that type of you're that's where you're at along where your business comes?
No, it depends on a couple of factors. One is, what is your future potential? That's what they see, in the sense you are able to grow at a 1x or a 2x in the next 12 to 18 months, 3 years, 5 years. The future potential is really important, meaning if your business doesn't have enough valuation today, but it has potential to become bigger in future, then the equity they ask is less, because they see potential for you to expand, and even with less equity, they are able to get their return on their investment.
Okay.
On the other side, if you have less traction today, and if your product or service is in such a way that you can grow only up to a certain point, then your equity percentage could be slightly higher, because the investor needs their return on investment. So they may need it through higher equity. So think of it more like a bank loan or something that you will take, where you have sufficient collateral, you are taking less principal for a shorter period of time. Your payment on a monthly basis is different from, you take the same amount of money for a longer duration, then your monthly payments are a little bit less, right? So it always depends on the future potential of what you can grow into. And if that growth is projected higher, the equity percentage that the investor takes will be lower.
Okay. How likely is it for a nonprofit to find an angel investor?
Yeah, so nonprofits typically go through crowdfunding or even an angel investor, but they don't have equity, right? Because nonprofits don't have a profitable business that can give ownership or equity. In those scenarios, angel investors are also able to give you loans. They are not called loans, but they are known as convertible debt or private credit options. It's not like your typical bank loan, but it's not a personal loan. It's more the angel investors' loan into your business, with the promise of you paying back at a later point in time without equity ownership. In this scenario, the payment could be slightly higher, because you're not giving anything else to the investor in terms of your business ownership.
Okay. We have what type of companies have you raised funds for? What are the key sectors and also the rough size?
So I have been involved in almost all types of startups and small businesses. Typically, the type of companies are they have some customer traction. They are waiting to expand or bring in new products or bring in new team members or expand into a new market. Those are like three types of areas where they have raised funds. In terms of key sectors, sectors doesn't matter as long as you are able to show traction. In terms of rough size, I'm not sure what the rough size is. The rough size could be anywhere from 5K to 500K. Sometimes, I mean, if you are raising more than 500K or so, it not necessarily falls into angel investing, but then that falls into venture capital. So, from my personal point of view, I've done angel and venture capital, angel starting from 5K to 500K, venture capital anywhere from 500K to 10 million or 20 million. But angel investing should be less than $1 million. That's why it's called angel investing.
Okay. All right. So we have come to the end of our meeting. I just want to remind everyone, if you want to talk more in depth about the type of business that you have and how angel investing can play a piece into you growing your business, scaling your business, please reach out to me. Tomorrow I'm going to send an email with the recording and the slides. Just answer back and say, hey, I would like to speak to Buva. You can speak to her at a no cost and we'll coordinate that. And I also wanted to tell everyone that if you haven't already, tomorrow in the email, we're going to remind you that on the 12th, we're going to have a class on getting found online, SEO and Google business. And on the 13th, there's going to be a webinar where I talk about grant opportunities that are available for small business owners. So I thank everyone for joining today. One last question, really quick, Buva, so we can hop off. She has a question about traction. Is not worth reaching out to angels until you have traction. So if you don't have any traction, should you even bother reaching out to angel investors?
Yes, because traction can be customer traction and or revenue traction. As an example, if you have 100 repeat customers, you have not yet in a break-even point, you have some revenue that goes directly into cost of delivering the product and service, which means you do not have any profits, but that doesn't mean customers don't need your product because they are still working with you, they are paying for you, you're just not in a break even or a growth point. So if you have customers, partners, or regional markets where you have established presence, you have some of them paying, some of them are test customers, you've not yet generated higher profit, and that's why you are raising this fund from an angel investor, you should reach out. If you're trying to look for venture capital, then revenue is must, that you should be generating profit beyond a break-even point to generate fundraising interest.
Okay, all right. Thank you, everyone. We're looking forward to seeing you in the next webinar, and I hope everybody has a great evening.
Thanks, everyone. Reach out to us.